Crypto is absolutely pumping out of the lows put in after last week and last weekend's nightmare. I don't think we're fully out of the woods just yet. I don't think it is yet time to celebrate, but there is a potential catalyst brewing in the macro environment which does have the potential to take us all the way through to new all-time highs, in my opinion. We have Bitcoin here at $110,328. Look at this. So we are up from lows. We made it as high as 7.88% up, and currently sitting at 6.5% up from the lows. From the weekend alone, we are up about 2.84%. And this move has been precipitated once again by liquidations, courtesy of short traders in the market being overly bearish and getting liquidated on the way up. So look at this. The CoinGlass liquidation heat map, you can see over the last 24 hours, $223 million worth of short positions liquidated out of the market. Now, it is not just a one-sided story because we have not just had one-sided price action. There's also $170 million worth of long positions liquidated out of the market. Things are a lot quieter over the last 4 hours, but that is to be expected, right? We have basically a contraction of volatility here. And like we spoke about time and again, people see green shoots like this. They jump in on long leverage. They get liquidated to the downside. And a load of people see this move and they jump in short, adding to the cumulative short leverage that's been building up really ever since we started failing the all-time highs, which is now sitting at over $5 billion worth of liquidation risk to the upside. So people see a move like this coming down. They don't see immediate resolution, immediate gratification on their long position. They hop in short, and sure enough, they become stopped out, emotionally capitulate, and get liquidated, further pushing that move to the downside. We then bounced off forward resistance here at this level, $107,500, and the exact opposite happened to all of the traders here that got short. And once again, that residual backlog of short positions in the market who have been building up ever since we failed to make new all-time highs. And we came through here and we absolutely eviscerated those shorts. Now, we couldn't quite break through market structure. We couldn't quite break through the local highs here at $112,000. I don't think that is a disaster just yet. If we take a look at the current liquidation level, so that $112,000 mark is worth about $186 million worth of short liquidations. And the next level to the upside, the next most important level to the upside, are these highs here, right, at about $113,500, which is a very significant part of the liquidation map because it is where liquidation risk essentially peaks, and that is worth about $618 million worth of short liquidations. And that is, once again, at these highs here. If we're being very, very strict, okay, and we're calling this the high, this the next low, this the next high, this the next low, this the lower high, and this the lower low, we have technically broken this high here and thus broken out of the downtrend. But I would say that this region here is much more contested and much more significant to calling this a true bounce away from the lows. But we've been over this before. Back when we've seen such aggressive selling like this, we have tested the lows of that initial sell-off multiple times before moving away to the upside. So all of this to say, basically, this is a strong move, okay? And the playbook is happening again, right? We are starting to shift the tide now and start liquidating some of those short positions, but I don't think we're out of the woods just yet. And as always, if we look at this on the 1 day, okay, we're pretty balanced right now, but we are slightly stacked to the downside in terms of long liquidation risk, because history dictates that a lot of people would have seen these green candles and hopped in long, and history would dictate that a pullback like we're experiencing right now, a localized pullback, is probably going to come around and liquidate some of those long positions. Also, if people jumped in and placed their stops around lows such as this one here, or more likely here, it's likely, very likely, that we could pull back, take out some of those stops and get back into liquidity down here. But we could equally play this out to the upside, right? As I've said time and again, there is a backlog of short liquidation risk to the upside. And that is a very similar scenario except on the opposite side of the market as to how this massive, historic $19 billion liquidation event happened, right? We know that this was caused by basically too many people jumping in leverage long on the run up to all-time highs and then becoming liquidated to the downside. So ever since we've been in this downtrend, people have been stacking in their short positions, and I could see the exact opposite of this scenario happening again. But indeed, on this down move, the fire was set, but we needed the spark, and the spark was the catalyst, and the catalyst was Trump threatening further tariff increases on China. So what would the spark be to the upside, you might ask? I think the answer lies in the upcoming FOMC meeting. So Fed Chair Powell recently spoke at NABE in Philadelphia. This is the transcript of his whole speech, but he made some specific comments on the state of unemployment in the US, which are leading many analysts to believe that further rate cuts are becoming more and more likely going into the next FOMC and beyond that as well. So here we go. Fed Chair Powell says the US economy firmer than expected, but warns of rising labor market downside risks. Powell says that the latest economic data is suggesting growing downside risk to the labor markets despite the economy being on a firmer footing. Specifically, based on the data we do have, it's fair to say that the outlook for employment and inflation does not appear to have changed much since our September meeting 4 weeks ago. Data available prior to the shutdown, however, show that growth and economic activity may be on somewhat firmer trajectory than expected. In the less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. So Powell's comments are in line with increasing bets on another cut in the Fed funds rate at the next Federal Open Market Committee meeting, that is FOMC, to me and you. You can see here on FedWatch, we are at a 99.4% chance of another 25 basis point rate cut. And this is likely already priced in, okay? You can see gold up some 3.5% on the day. S&P almost right back at all-time highs, okay? Right, bounce straight back from that 3.8% drop after Trump's tariff threats last week, or the week before actually at this point. So there we go. Most of this data is already priced in, but what is key here is what Fed Chair Powell comes out and says about upcoming rate cuts, about the further projections into the future from that. We've also got this little nugget here, right? Some analysts see imminent Fed halt to balance sheet drawdown on rate turbulence. And this essentially means an upcoming end to QT or quantitative tightening. Some Wall Street analysts now believe that the Federal Reserve will pull the plug on its long-running effort to shrink its balance sheets at the end of the month. That is quantitative tightening. These central bank watchers believe the ground has shifted for quantitative tightening due to mounting money market friction, which could threaten the Fed's control over the interest rate target it uses to achieve its inflation and employment goals. Typically, what happens after quantitative tightening is a return to quantitative easing, which is essentially money printing, right? Turning the tap on, putting liquidity back into the market. And at least in the short term, that tends to be very bullish for risk assets, including our beloved crypto and our beloved Bitcoin. I think it is very possible that Fed Chair Powell comes out and treats us with some further dovish statements at FOMC on 28th to 29th of October. And that could just be the catalyst, which brings us back around full circle to start injecting liquidity into the market and ultimately liquidating some of this massive $5 billion short liquidation risk that is now set in the crypto market. Short liquidations means forced buying onto the market. Forced buying on the market means a sudden demand shock, and a sudden demand shock means numbers go up. But as always, that is just my opinion, pure speculation, and just what I'm looking at. I'm sharing it with you only for entertainment purposes. Nothing I say should be considered financial advice. But thank you so much for watching. Thank you so much for listening. Plenty more to come. Catch you in the next one. Bye.